In this presentation, we will make loan payments considering how to break out the interest and principal portion on the loan with the use of and understanding of an amortization table within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in our Get Great Guitars problem. We're going to see what our objective is first by going over to the balance sheet, going to the reports on the left side to open up that favorite report, that balance sheet report. It should be up top in the standard reports is going to be the tab we're in the favorites, because it is indeed our favorite, the balance sheet report. We'll make the date range then 01/01/19 to 12/31/19 and run that report. That's of course January through December 31st, 2019, the year that we are working on. We're considering now the loan payment. So the loan is going to be a liability. We have the loan on the books. We have recorded the loan on the books because we got money from the bank. We put that loan on the books and we say that we have to owe that money back. It's going to be down here in the liabilities section. As we scroll down through the liabilities, we see loans payable $72,000. If we select that loans payable, we'll see that it's made up of two things. We started off with $22,000 and then we had a $50,000 that we took from the bank. So the is that we're going to assume that we've refinanced the loan here at the $72,000 at this point in time. So we've got the $72,000 loan. Note that if we think about loan, the problem with a loan, of course, is we'll have to pay it back, number one, and we'll have to pay interest on the loan as well. How we deal with that repayment, how we deal with the interest and principal payments in the future could vary. It could have an infinite amount of ways that we could set up a loan payment and how to pay back that loan payment. The most typical way for many things that we will finance, however, if we think about a home loan, something like a mortgage, or financing any type of item, is that we have a standardized amount that we pay in a standardized period, often a month, and that standardized amount will be the same each month. However, because we're making that amount standardized, the thing that will change, the thing that will differ is going to be the interest. So we'll start off with that. We're going to start off with that kind of normal type of loan payment that we're used to seeing in something like a mortgage or when we refinance a loan. Note that if we get a loan from the bank, we may have different terms. We may say, hey, we want to pay the interest and principal at the end of the loan and have some type of different terms on the loan. But many times the bank and the individuals like the payment systems being standardized with interest and principal changing, but the payment being the same, because that helps with our cash flow budgeting. So that's what we'll consider here. If that's the case, then when we make the payment's going to be the same. That's going to be easy. Once we make the payment from a bookkeeping standpoint, we just write a check. But the problem is that we can't write the other side of it to just decrease this loan payment because part of it is interest. So to consider the interest and principal portion, we need an amortization table. And oftentimes that's not given to us by the bank. So we would have to basically generate one or ask our CPA to generate one if we were to enter the loan, breaking out the interest and principal properly. If we aren't breaking out the interest and principal properly, it's possible for us to just make an adjustment periodically as an adjusting entry. In other words, it's possible for us to just record the entire payment, interest and principal, to this loan and then adjust it on a monthly basis or yearly basis to the outstanding loan balance in an adjusting entry format. We're going to look at that amortization schedule and consider this problem a bit further and then record both the interest and principal as we make the payments. We'll work this in Excel. So here's an Excel worksheet. We'll just go through this to get an idea of the principal and interest and why this is an issue. It is an issue and a problem or something we need to think about with any type of loan that we make. So if we have the $72,000 loan, we're going to say that that loan is going to be over a 5-year period. So we're going to make monthly payments on this loan over 5 years, or that's going to equal 5 years times 12 months in a year. And that gives us 60 payments. So we'll have 60 payments. We're going to say that we pay a rate of 5%. Now, when we consider the rate, note that the rate pretty much always means a year unless said otherwise. Meaning, for example, if we had a home loan, a mortgage, and we're paying 5% interest, it means 5% a year even though we're making monthly payments. Why? Because that's the convention. That's just the assumption. Just like if we were to say that what's the annual salary of someone, what's your salary, we're just going to say annual typically, unless we specify otherwise, saying this is my monthly salary. We typically just say this is the yearly salary. Why would that be the convention? Because if we were having a period less than a year, the interest rates would be very small. We'd be talking about fractions of interest rates, and that's not something that's easy to talk about. It's easier to talk about in interest rates that are around a year, because those are going to be interest rates that are between, typically, hopefully, 1 in 100, which are easy to consider and think about. So if we then have the payment down here, we're usually given the payment when we have the financing. So we're usually given it, but just note that if we don't have any of these variables, we can make a calculation for the missing variable. Just to show that, we'll do that with an Excel function here. So we'll go to the formulas up top, and I'm going to find this formula to make it a little bit easier for the input. And we'll say that we want to find this formula, and we want to find a payment. So if we look for a payment, then we're looking for this PMT. That's the one that we're going to have, and it's going to give us a little information on the payment on this formula. We'll say that's the one I want, so okay. And then we get this little information box that'll help us fill this out, just to give us an idea of what the payment is consisting of as we look at this. So we're going to say the rate of the payment is going to be this interest rate. However, we're going to pay it monthly, and this is the yearly interest rate. So the tricky thing here is we got to take that rate, divide it by 12. That's going to be the monthly rate. And then we have the number of payments. It's a 5-year, 12 times a year, 12 months. So that's going to be our 60 that we'll have. The present value then is at this point in time, how much the loan is now, which we took out, $72,000. That's the loan at this point. These two are not required fields, so we won't have anything there. And this should then give us our payment amount. So if we say, okay, then we get our payment. I'm going to make it a positive number instead of a negative by just double clicking on it. This is the formula. I'm going to put a negative before the P just to switch the sign. So note this formula. Payment, it's a function, equals PMT brackets. We want to take B3, which is going to be the rate, divided by 12 for the monthly rate, times B2, monthly payments, and B1, which is the present value or loan amount. And you can see as we go through this, it'll give us a little checkbox here, which is nice to help us kind of check out and make sure that we're getting the right information there. So there we have it. Now note that this is usually the calculation when we have a loan payment that someone does for us. And this is all they know, really. We just know the loan payment, and we don't really know the difference or the relationship between the interest and the principal. So it's nice to work through something like this and get an idea so that we can record it right from a bookkeeping standpoint and get a better idea what we're paying for. Note, of course, if we were to take this amount, this 1359 times 12 or times 60 payments, which we're going to make, it's clearly greater than that 72,000. And therefore the interest we're paying, the 5% interest is minus the 72,000 or 9,540. So we're paying a lot of interest here. That tells us how much interest we're paying over the 5-year period, however, not how much interest we're paying each month. I can't just take this number and divide it by 60 to get the monthly interest payment, because it depends on the principal changing. It doesn't quite work that way. That would be a straight line method. So let's see how it does work and see how this plays out. To do that, we'll do a little amortization table. We need this amortization table in order to properly allocate the interest and get an idea of what the interest is doing. So here we have the number of payments, which is just going to be 1 all the way down to 60. Don't worry, we're not going to fill out everything manually. We'll use Excel to fill this thing out. But we want to go through the first couple payments just to get an idea. The first payment, like all payments, is just going to be equal to the payment amount we have. The interest that we're going to pay is going to be the principal, which in this case is the 72,000 times the interest rate, 5% divided by 12, however, because we're looking at a monthly interest rate. So in other words, we'd have the 72,000 times the interest we're going to pay, 0.05, 5%, which would be 3,600. That would be for an entire year, however. So to get the interest for a month, we can divide it by 12, and that's going to give us our interest per month. So let's do that here. We're going to say this equals 72,000 times the interest rate divided by 12. And that gives us our interest per month for our monthly payments. If this is the amount we're going to pay and that is interest, the rest is the principal reduction. That's what we're paying down on the loan. So that equals the payment minus the interest. And this is just how you would make an amortization schedule. So then we're going to say, all right, so now the new principal is 72,000, the original loan amount, minus the principal reduction, the amount that wasn't interest on the payment. So then we're just going to keep doing this. Note the payment doesn't change. The payment is the same. So I'm going to say this equals the same payment amount. But the amount of interest now changes because the principal has now changed. The interest is just like rent on the money we have. And the money we're borrowing, the amount of space we have, if we're talking about renting an apartment, the amount of square footage has gone down. So the rent on it has gone down. What we have here is money that we're renting. We paid some of it back. We don't owe rent on the whole thing anymore. So now we only owe rent, we only owe interest on the $70,941, not the $72,000. We're paying rent or interest at 5%, 0.05. That would be for an entire year, however. We're doing this monthly, divided by 12, because we're paying it back monthly. That's the $295. Notice it's rounding, it's going to round over here. So let's do that over here. We're going to say, all right, now this is the principal times the 5% divided by 12, and that's the $295. So you can see the interest is going to change as we go. That's the point. That's the problem. So when we make these payments, we're going to have to allocate between interest and principal. Not only that, but the allocation between interest and principal will change due to the fact that we have this funny schedule that we made because we want to make the payments the thing that stays the same through this process, and that means interest and principal will vary. So we're going to say, all right, so now this equals the payment minus the principal, and the new principal now equals the prior amount minus the reduction, the amount of payment we made now that's not interest. So the amount of payment we're making that's not interest, the reduction of the loan is going down at a greater rate. We're paying more of the loan off as we go. The interest being allocated is going down. So we'll do this one more time, and then we'll use Excel to kind of finish this thing up. So we're going to say the payment, once again, is the same. The interest equals the principal that's now lower again. It started at 72, now it's 69,878, times the 5% rate for a year divided by 12 to make it for a month. The principal reduction then will equal the $1,359 payment. That remains the same minus the interest, which varies, differs, goes down, and therefore the amount that's being paid off in principal goes up. The principal reduction then, the new principal amount, is going to be the prior principal minus the reduction amount that we have here. And so we can see what's happening. All of our payments are the same, but the interest amount is going down and the principal is going down. So to properly record these payments, it's not the same. It's not something that's going to be the same each time period, each time we make a payment. That's a problem for us using QuickBooks because we can't just memorize the transaction. We have to actually change the transaction each time to allocate a different amount between interest and principal. So now we're going to use Excel to just copy this down so we can see this all the way down. So we're going to say this equals the payment. Well, to do this, first, what would happen if I just copied this down? If I select these cells, I'm going to use autofill to just kind of copy and paste it down by putting my cursor on this square and just dragging it down. And it does what we want there. That payment's the same, but here it doesn't because it moved the interest rate down. This is what we want, but this isn't what we want. I need to tell Excel, don't do that. Keep it at the 5%. So how do we do that? I'm going to undo, undo, undo. I'm going to take this cell and we're going to make that 5% an absolute reference. It's in cell B3. So within B3, I'm going to select F4 on the computer, or you can just put a $sign before the B, a $sign before the 3. We only really need $1 sign, a mixed reference, but an absolute reference is easier to conceptualize. So we're just going to say $sign before the B, $sign before the 3. Has nothing to do with money. This is like Excel code telling Excel, hey, do not move this cell when we copy the formula down. So now let's do the same thing. I'll highlight these cells, select them, put our cursor on the autofill, drag that down, and now this does what we want. That's the same. This does what we want. This times the principal, which drag down, divided by 12. The principal reduction does what we want. The principal does what we want. Now we're just going to drag this all the way down and see if it does what we would expect after 60 payments. What would we expect? The principal to go down to 0. So we'll get an idea of how to build these amortization schedules so we get a better idea of what we're recording when we enter this. So we'll highlight this, drag it down in the same fashion, and hope that after 60 payments, this amount goes down to 0, that giving us a check that this is all working out the way it should. So we're going to say, all right, let's autofill all the way down. Auto drives it down. Dr. Phil's going to put in those calculations, and we'll work together and see if we can get that filled out. Down to 60 payments, and there it is. It goes down to 0. You'll note this last payment. This is the same on a mortgage. This is the same on financing a car or cell phone, anything that we have interest. We've got now the same payment on the 60th payment. Only $6 of it is going to interest. All the rest is principal, going down to 0. Why? Because the principal balance we're paying on, the rent that we're paying, if we're paying for an apartment, the square footage is decreasing on us, and therefore we're paying for less space. We're paying for less rent on money that we have here. We're only paying rent on $1,356 as opposed to the $72,000, and therefore the amount of rent, the amount of interest, is much smaller in comparison to the principal. So that's going to be the essence of what we have here. Now that we can take this amortization table, and when we make the payments, we can allocate properly depending on the payment between interest and principal portion. We're going to use this now to enter the first 2 interest payments. So we're going to make a payment on the loan. We're going to say this is going to be our first payment. We're going to make this payment as of the first of the month, and then we'll make the second payment as of the end of the month, just so we can make that comparison. We're going to see them side by side so we can make this comparison. Back to QuickBooks here. I'm going to scroll back up. I'm going to go back to the balance sheet up top. And let's keep the balance sheet around here. So we're going to make another tab up top. I'm going to right click on this tab up top and duplicate it. Duplicate that tab. And then I'm going to pull the one to the left over to the right. So the balance sheet is on the left and we're going to work on the one to the right. Then we're just going to write a check. We're going to go to the checks over to the left. We're going to go to just writing a check. We're going to pay off basically just part of the loan payment, which is going to be the same each time. We're going to say the bank is Chase. So we're going to say Chase is the bank that we are paying. And so they're the one we took the loan from. It's going to be coming out of the checking account. It will be a check coming out of the checking account. The date is going to be the February, so 02/01/19. We're going to say that this is the first payment that we're going to make, which in essence was for the end of January that we're going to make at the first day of February. Then we're going to say the check number looks good. We're going to go down to the accounts now. Now here's where the difference is. We know what the payment amount is. We got the payment of the 1359. However, there's 2 things that make it up, interest and principal. So we're going to have to enter those 2 items now. So the major portion of it, or the main part of it, will be the loan payable. Loan payable meaning the principal balance going down. So we'll go to the loan payable account. That's the account that has that $72,000 in it. It's not going to go down by the full amount that we're writing the check for. We're writing the check for $1,359. It's going to go down by the $1,059. So we're going to say, all right, the amount is 1059. Then we're going to have to add another account to make up the difference, the interest portion. I would typically call that interest expense. They're calling it interest paid. So they have set up an account for us called interest paid. It is an expense type account, so that's the one we will keep. Going to say tab. The interest portion then is going to be that $300 for the first payment. So we'll go back over here and say $300. That's the interest paid. The total amount then, $1,359. That tying out to the $1,359 payment that we will be making. So we're going to say that looks good. And so let's save and close and check out the reports. We're going to go save and close. If we go then back to the balance sheet, I'm going to go to the balance sheet on this side, run that report again, and we scroll down to the liability, we'll see that 72 is now at 70,941. 70,941 matches our amortization table. So that's looking good. It looks like it should. If we go into that 70,941, we'll see that check. Here's our payment, bringing that 72,000 balance down by 1,059, only by the principal portion. If we select that item, it's bringing it down just by the principal, although we paid 1,359. Where's the other side? On the profit and loss. Closing this back out, going back to the second tab, let's open up that profit and loss. It's going to be on the reports. We're going to say the profit and loss, our second favorite account. Scrolling back up top, we're going to say for the year 01/01/19 to 12/31/19, run that report and scroll down, and now we should have interest paid and expense. There's the $300. There's the other side. Now we're going to go back and we're going to do this recording again for the second payment. This will be at the end of the month, so we're going to jump forward to do this. We're going to do it now and do one at the beginning, one at the end, one a full month later, because we want to put them side by side so you really get the idea of seeing the difference, the problem, the issue of making loan payments and breaking out the difference between principal and interest within them. So we're going to make this second payment now. Same amount we're paying. Remember, it's 30 days later. We're going to pay the same amount, but the interest and principal portion will differ. So we'll go back here. I'm going to make another report again. So I'm going to right click and duplicate this again. So we have two tabs, or three tabs now. I'm going to pull this one to the right. So we've got a balance sheet, a profit and loss, and then we have something we can work in. We're going to write a check in it. That's what we're going to do as we work in it. We'll say the plus item. We're going to write another check. And we're going to make another payment to Chase. And you're imagining a month has passed. It's a month later. Writing the check to the checking account. We've got to make another loan payment. It's now a month later, the end of the month, 02/28/21. So we made the 02/28/19. So we're going to make the payment a full month later, but it still lies in the same month so that we can keep it both in that month. And the check number is what it is. We have the same items down here. Notice what QuickBooks did. It tried to memorize this transaction for us, and it did a great job of it because we have the same payment, but it's not perfect because we can't allocate the same amount between the loan payment and the interest. It would be great if we could, because this amount down here will be the same each time, but these two will not. So it's great that it memorized these two accounts, but we can't really rely on these two items because they change. That's the price we pay for making the payment amount the same. So, okay, so we got to go back here and say, well, the principal now is going to be the amount of 1063. So this needs to be 1063, and the interest portion needs to be 296. So this is going to change to 296, which then results in the 1359, which is the 1359 same amount. So that's going to be the tricky part. That's the tricky portion. And remember, we're jumping forward in time. This happens month to month. We're going to make these payments each month, but to properly allocate, we got to change the interest and principal portion. If we save and close this, we'll take a look at our reports again by going to the balance sheet on the left, going back up top. And then if we scroll down, we'll see the loan payable. There it is, the 69,878. It's going down. If we select it, then we see our two payments, and their principal portion is different. The 69,878 then should tie out to our statement. There's the 69,878. So our amortization table is working for us there. The other side of it, of course, on the profit and loss, second tab. If we scroll down, we're going to see the interest paid, 300. We'll run that report again because that's only half the interest. Run that report. Interest paid, 596, which of course is the sum of these two, 596. And if we go into the interest that has been paid, we can see that we have a different amount for the two payments, the one a month before the other. So we're jumping at the beginning to the end of the month just to show that comparison. That's going to be the issues with the loan payments. Note, you could kind of shortcut this process by simply doing an adjusting entry. In other words, you may just want to make a loan payment to the loan payable account for the entire amount, and then on a monthly basis adjust your loan balance to whatever the bank says it is and put the difference to interest. So you can just kind of do an adjusting entry at the end of the month, correcting your loan balance and writing the difference off to interest. By doing that, you don't need an amortization schedule. You don't need to set one up. You're kind of depending on the bank to tell you what the proper interest is and just lining your information up to the bank on a monthly basis using an adjusting entry type process. For more accounting information and accounting courses, visit our website at accountinginstruction.info.